Welcome to Sell Any Biz podcast. If you ever wondered how private equity deal work behind the scenes, you're in a treat today. Today we are joined by Andrew K. Reilly, Managing Director at VCFA Group, a secondary private equity investment firm with 17 plus years of hands-on experience in venture capital and growth equity. Andrew has seen it all. He's here to break down the complexity of private equity and share insights with us that can help investors and entrepreneurs and our listeners and business owners navigate this evolving landscape. Andrew, welcome to the show today. How are you doing?
Thanks to hear. It's great to be here. Thank you.
Okay, Andrew, you've been leader in secondary private equity market for years. Can you break down what VCFA Group does and how it plays a role in M&A industry?
Yeah. Thank you. Look, VCFA is an interesting and storied firm that I've had the pleasure to run for just a number of years now with my partner David Tom. But I think it's interesting to go back in time to where it all started. So VCFA is short for Venture Capital Fund of America.
Right.
It's a mouthful, I know. It was actually a catchy name in 1979 when no one really knew what venture capital was.
Mhm.
So we were founded by a guy named Dayton Carr, who was really one of the first and earliest, among the first and earliest groups of venture capital investors, believe it or not. So before it was even called Silicon Valley, a guy named Thomas Watson tapped Dayton Carr to go run a venture firm. Well, Dayton didn't know what a venture firm was, but he said, neither do some of these other folks. And what we think was Tom Watson, who was then chairman of IBM,
Yeah.
wanted a picture of what was going on with some of these real, what we think of the seminal names in venture capital at the time. So Dayton, armed with a little bit of IBM money
Mhm.
and a relationship with Tom Watson, started making fast friends of the real pioneers of
Mhm.
venture capital. He was lifelong friends with Eugene Kleiner and Tom Perkins, Sandy Robertson, Rick Burns, founder of Charles River, and I could go on. Dayton, believe it or not, was the reference letter for Kleiner Perkins One when they were trying to get off the ground.
Yeah.
So, just to give you a little context of how far this goes back, um, fast forward to 1979, and Thomas Watson gets tapped by then President Jimmy Carter to be ambassador of the Soviet Union.
Mhm.
He has to divest his personally held private equity and says,
Mhm.
Dayton, why don't you buy me out?
Mhm.
And that's largely regarded as the first time an LP interest or secondary transaction in the private equity world happened. So
Mhm.
Dayton bought that interest from Thomas Watson um, at a good price, much later in the fund cycle and much cheaper.
Mhm.
And 4 or 5 months later, exited a couple of those positions, made a lot of money, and said, hey, maybe there's a business here. So VCFA as a secondary is a private equity investor. We focus on venture growth, but we do so by buying later into that cycle and
Mhm.
usually at a discount. And
Yeah.
that really was the beginning of the whole secondary market. So VCFA was there first. Dayton was part of that first transaction and started a series of small funds from 1982 to like the late 80s. And
Mhm.
during that time, if you were a private equity limited partner in a fund and you wanted liquidity, um, you either sold to Dayton or you didn't sell.
Right.
He was the only option. And then he helped build an industry. So a lot of the biggest
Mhm.
firms and names and have the ones that have been around the longest, Dayton, Dayton's fingerprints are on those to help those folks
Yeah.
get going. So he
Mhm.
not only started the industry, he helped other participants into the industry and have it grow. So VCFA was there at the beginning. We're
Right.
still here,
Mhm.
and that's sort of an interesting history I thought I'd share.
Right. Very, very nice introduction. So tell us a little bit, elaborate about secondary private equity and how does it work?
Yeah, so if you think of private equity, it's just this massive industry now,
Mhm.
right? And it's grown so much. I've seen it from a bunch of different angles, and one of those is as a limited partner, as a board member of a state pension fund,
Mhm.
of all things, a position I held for a while. I saw the growth of these what we think of as the big buyout firms, right?
Mhm.
Apollo, Carlyle, Blackstone, et cetera. You
Mhm.
know, if you want to do your own research, look back to like even the late '90s, mid '90s. Um, they were not that big. Those firms were not that large. All of a sudden, you see this hockey stick that
Mhm.
happened sort of in the late 2010, 11, 12, in the teens, where all of a sudden the fund sizes and the
Mhm.
appetite, I would say, from large state pension funds backed
Mhm.
by their consultants, et cetera, that engine, that machine, that conveyor belt, if you will, of
Yeah.
capital
Yeah.
from uh, large pensions, institutional capital, et cetera. The spigot really got opened wide open about
Mhm.
15, 20 years ago.
Right.
And it just has been up and to the right ever since because these firms have delivered good and over time better returns than the average public equities strategy.
Mhm.
So, you know, private equity has grown tremendously. Now, you think of all that capital there, and it's a
Mhm. Yeah.
multi-trillion dollar industry.
Mhm.
Um, Many people find when they get into private equity, they say, wow, this is pretty illiquid. I can't just sell it anytime I want, like I could sell on the NASDAQ or the
Yeah.
S&P
Mhm.
um, or the Dow rather. It's not that liquid. So you can imagine with all those trillions of dollars in it,
Yeah.
and this is in buyout, mid-market buyout, credit,
Mhm.
debt, venture, growth, so much capital. Some people want liquidity earlier than those
Yeah.
private equity firms deliver it.
Mhm.
So hence the secondary industry and hence Dayton's idea to say, hey, maybe buying later in the private equity cycle and cheaper is a
Mhm.
great strategy. And it turns out it is. And it turns out that even at 150 to pushing 200 billion of annual volume,
Mhm.
that most people say the secondary industry is still undercapitalized. That
Yeah.
there's more demand for liquidity
Mhm.
from private equity investors than there is capital for it.
Right.
That, however, is probably an advantage to the investors in good,
Mhm.
experienced secondary private equity firms,
Mhm.
because those firms, which we are one, don't have to do every deal that comes over their desk. We can be pretty picky
Mhm.
and choosy
Mhm.
about buying really good assets
Yeah.
um, at at an appropriate level of discount where a seller will sell them to us much later in the cycle, or what we like to say is closer to exit.
Yeah. So,
Right.
so
Private
what?
equity can be a
Yeah.
long road.
Yeah.
Right.
So what type of businesses and investors take the most benefit of secondary private equity market?
Yeah. So I think the most benefit, and here's where the lights go off. Biased. This is going to be a biased statement I'm going to make.
Okay.
I think the most benefit personally is in venture and growth, and the reason is um, large mega buyout firms. Right. Like I said, the Carlyles, the Blackstones, the Apollos,
Mhm.
and
Big
then
names.
large growth firms. The big names are there. Large credit firms. If you can access those, they're good funds. They're good, but in venture particular, it's really hard to access the best firms. So
Mhm.
if you can't, the best way maybe into those firms or into those companies, right? Everyone doesn't have access to the A, B, or C round of some great growth company.
Mhm.
A lot of venture capital firms do. Trying to get access as an individual investor or even a small institutional investor
Mhm.
to the who's who of venture or even that tier two um, of venture is really difficult. So I think the best way into that for access, which is what I'm talking about now, is potentially secondary. But then also getting into those companies, those great startups, fast growing companies, and or those funds later and at a discount
Mhm.
really pays big dividends for venture because, as we know, companies, even the good ones, are staying private a lot longer to
Yeah.
either have good M&A or go public.
Mhm.
So in the old days, we could go public when you were a $30 million revenue company or $50 million company.
Yeah.
Those days are over. If you're going public now, they want you to come out with some multi-billion-dollar market cap,
Yeah.
or to be M&A, you really have to be a 50 plus million, couple $100 million company
Yeah.
is where this game has gone.
Mm.
So I would say in venture growth, and I'm biased because that's where we focus, that's where the most benefit is,
Mm.
right? Because those investments can be much longer. And for most people, they're really much harder to access. I think secondary is a better way to access these
Mm.
things.
Mm. Yeah, that's right. Yeah, so we've seen major shifts in industry landscape in recent years. So, what trends are shaping the secondary private equity market right now?
Well, all you read about, if you want to read about secondaries, is size, right?
Mm.
And GP led secondaries.
Yeah.
Um, so the industry, as I've said, is probably undercapitalized. If you look at the total of private equity and then you look at private equity secondary, we're really talking about only a couple, like single digit percentage points of
Mm.
secondary capital available to buy,
Yeah.
into this multi trillion dollar industry. So the trend is to have the larger players get larger,
Mm.
right? So, and
Yeah.
that's a typical trend in private equity in general. But the
Mm.
larger players have gone from $3 billion fund sizes to 10 to 20 to now 30.
Yeah.
So the new kind of high water mark is $30 billion fund sizes at that upper end of folks focusing on the big buyout assets mostly.
Mm.
Um, so that's one trend, and that is definitely going to continue. Bigger, 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 more capital. However, there's another trend as well, and it's I think born by the lack of liquidity that's been in the market for the last couple of years, and
Mm.
that's GP leds, which is where a secondary firm works with a general partner of a private equity firm, where their fund is getting a little bit long and hasn't delivered the DPI or the liquidity back to the investors that they would have liked by them. So they work with secondaries to say, hey, how about you bring capital into the fund? I can distribute that capital to my investors, raise my distributed or my liquidity to those investors to stay in line and keep ourselves in the performance that is expected from those investors. Now, the way a lot of them are doing it today
Mhm.
is single asset GP leds.
Right. Mm.
This is really just a private equity transaction, straight
Mhm.
up, I think. So it's a secondary firm or syndication of secondary
Mhm.
firms giving liquidity to a, a, a fund, right, and a
Mhm.
fund manager to
Mhm.
give some of that liquidity back to the investors who have been in
Mm.
that deal for 3, 4, 5, maybe more years,
Yeah.
but where the GP believes in the next 3, 4, 5 years,
Mm.
the company could really keep growing. So it's an exit point for the old investor base of this GP, and a new
Mm.
syndicate of investors come in for the last ride. The
Right.
one thing to remember is the old investors don't have to take the liquidity in many cases. They
Mm.
can roll, right?
Yeah.
But that really is a big trend. I think, don't quote me, but I think about half of the capital put out in the
Mm.
past year or so was really to GP led, and I thought I read over 50%, near 60%,
Yeah.
was GP led transactions. So that trend
Mm.
has really gone from
Mm.
not many people doing it to the largest part of the market. Now that it's not a new phenomenon. I think it's new to do in the massive um, in massive size
Mm.
deals. To be honest, VCFA has 2/3 of our capital that we put to
Mm.
work is in GP led, or I say restructurings. When you're restructuring a fund, we started doing these back in 1992. They seem
Right.
to be red hot now,
Mhm.
but they're not really a new thing. They're
Yeah.
just gobbling up all the capital because of the
Mhm.
lack of liquidity in the market.
Right. Okay. So, with the current economic uncertainty and the political, landscape, so how are investors and business owners adopting these strategies, particularly in M&A and secondary investment space?
Yeah, I heard there was a new administration
Yeah.
in the White
New
House.
sheriff in town.
It's hard to keep up with with the
Yeah.
news cycles, but
Yeah.
um,
New sheriff in
so
town.
yeah. So what does this mean for private
Yeah.
equity? What does this administration and the change mean for private equity? I'm not
Mhm.
necessarily of the school that for private equity, it's a huge change. I think for private investment in, say, blockchain,
Mhm.
digital assets and things, I think maybe there's some uplift there. But I think from last administration to this administration, other than maybe some regulatory, uh, um, pullbacks and things, I don't think there's a big change, and I still think you're seeing a little bit of uncertainty and a little bit of questioning where the overall economy is headed. This administration definitely still met with threats of inflation, high cost of capital, interest rates are still up there. So I don't think just the fact that it seems like sentiment about the economy is good, that doesn't exit a company, that doesn't put money in the banks of middle America. So all of these things that this administration is trying to do,
Hmm.
it's the jury's out. I think some people are excited about it, some people are really nervous about it.
Yeah.
So we'll see where it plays out. For private equity, I think there is still a dearth of dry powder, but also a lack of liquidity in the conventional M&A markets. So I think you'll see secondaries in particular continue to be that fuel of the not the only, but the lion's share of the exit activity happening for private equity funds is them selling to secondaries, not so much the M&A market. There's little green shoots and signs of that changing.
Hmm.
The one I'll share with you that's proprietary is that all for let's see, all of 23, our deal lawyers, a lot of law firms and small firms we use to do deal work,
Hmm.
close deals and do legal, were kind of calling us saying, "Hey, you got anything? We're it's near the end of the quarter." And we say, "Yeah, we have a few deals, but not many." At the end of 2024, we were trying to find everyone we could. We have a lot of relationships with lawyers, as you know, and everyone was booked solid,
Right.
trying to get deals done at the end of 24. Now that becomes visible a little later, but I think that was one little bellwether stat for us internally, saying, "Hey, okay, there's a lot of M&A and deal activity out there, much more so than the year and a half prior." So I
Right.
think I think from what I'm reading and from what we're actually feeling, I think the tide could be turning. What I'm surprised at is the IPO markets
Hmm.
aren't on fire right now. I think the demand for good um, and let's face it, like tech mostly,
Yeah.
um, is I think there's dry powder there. I think both people, institutions, hedge funds are craving some of these companies that have not gone public for 2 years and had that much more time to grow, profitable, hundreds of millions of dollars or more in revenue, et cetera. I just don't know why that spigot hasn't started sooner.
No.
Um, IPO windows are only so large, and I think the fact that this is a lot of companies have said and have been very clear about their intentions to go public in 2025, 2026. I'm really surprised that the bankers, the large the large uh, markets, S&P, excuse me, Dow, Nasdaq, haven't started that big train going earlier. To me, I think we'll look back and think that was a mistake. There's appetite right now. These companies should be going public by mid-March, and I hope to see that. But that will actually um, fuel the M&A market that I think is trickling back, and that will really add a lot of fuel
I think
to it.
it's got a lot to do with the current administration's changes and how all the tariffs and stuff will. So
Well,
just
look,
settle down a
look,
little bit more before you go
it,
public.
it could, it could, but I wouldn't let that get in the way, because historically, that really, look, if you are a wildly profitable 45+% growth company, there is appetite that, despite what the heck happens with tariffs,
Yeah.
right? And this is an administration that's been in before, has used the T word all the time, and we always end up with, like, okay, great, the tariffs ended up being a negotiating tool, and there we go. So most of the talking heads have tariffs wrong, and
Mm.
they always have.
Right.
So I think the people who are sober about what's going on and really just see what's happening and don't over listen, I don't think that's a factor in a high growth, highly profitable company going public, where the appetite is absolutely there for it. And if there's anything that's going to really move the private equity markets, and anything that's going to have people excited about, or at least have a slightly better sentiment about public markets.
Mhm.
It's the size of the IPOs that are ready to come out. I mean, these will be some of the largest IPOs we've ever seen,
Mhm.
and a much larger basket of them coming out.
Yeah, yeah,
Yeah.
yeah. So VCFA Group, are you focused on particular industry, or you take care of all the companies which comes into your investment thesis?
Yeah, so we're unique in that one thing we've done, as I told the story about Dayton
Mm.
car, we stayed small.
Yeah.
And I think a lot along the way, people said, "Well, why isn't VCFA, the biggest firm out there? Why don't you raise tons of money?" I think back in the day where we were, kind of staying small and the industry was growing fast, it was because our founder, and who was still running the firm, Dayton Carr, didn't want to manage a huge firm, just plain and simple. I think he liked a boutique sized firm, and
Mm.
and that was that. When David, Tom, and myself took over day to day operations back in 2017,
Mm.
we kind of saw a little bit of genius in that. We were wondering why we weren't a bigger firm.
Mm.
But as the market has gotten huge,
Yeah.
um, every deal that's over a certain size, and just so you know, this is a staggering stat, the
Mhm.
average secondary deal, just transaction size now, is between 100 and $200 million.
Right.
That's a very large
Yes.
average transaction size.
Mhm.
It used to be in the single digit millions. So if you look at that, look, if you're an institutional holder of private equity assets and you are selling them,
Mm.
you're probably not doing that alone in a vacuum. You probably have a committee, this and that, and you're not going to sell $100+ million worth of assets without getting a lot of bids. So
Mm.
you tend to go to an investment banker,
Yeah.
right? In this case, called an intermediary, just secondary lingo for an iBank, who's going to help you sell your private equity assets, and they're going to go out, use all the relationships, and get 5, 10, 12 bidders
Mm.
on that.
Right.
And so the typical thing is best and finals due Friday, and you'll get the call Friday night or Monday morning that, gosh, you and the top 3 bidders were almost right on top of each other. We're going to do another best and final next Friday, and everyone's going to outbid one another.
Yeah.
So that's all in the very large deals. And
Mm.
so I jokingly sometimes say to my friends and who run these much larger private equity secondary shops, "Are you do you know if you're happy or sad if you've won or lost a deal?" Kind of a confusing question, but it's like,
Mm.
you know, congratulations, you just won $150 million transaction and you outbid 9 of your peers, right? So
Yeah.
is that good news or bad news? Or, you worked for 3 months on a deal and lost it $110 million transaction by $3 million. How does
Yeah.
that feel? So that is a very competitive industry.
Mm.
They all, however, when I say they all, the larger firms you think of in that industry, Lexington, uh, Landmark, Ardian, Strategic, which is Blackstone's, these are very talented firms and very good underwriters, and they have the dearth and the volume to kind of play in that highly competitive game and still return very good returns to their investors. We're the other bookend. I mean, we're raising $250 million funds. We're focused on venture and growth specifically, and what I like to call is like end of life venture.
Mm.
We focus on, really, first, we're company centric. We want to invest our investors' money into a great growth company,
Mm.
right? Later in the cycle, so after they're done their A, B, after they've been through the venture cycle and they're really in that growth phase. And what we like about that is, if you're trying to do a secondary and a buyout firm, well, buyout's a control world, right? There's Carlisle owns it, and maybe they let the one of the Canadian teacher pension funds in for a small co-invest. So if you want to buy a great company that's a buyout firm, you can't. They're not going to sell it, and certainly not at a discount. However, in the venture and growth world, that cap table is still so deep. Many, many pages of rows of, sometimes 80, 100, 200 investors, venture capital firms at the top, A round, B round, C round, D round leads, and then a whole bunch of institutions or individuals. So what we like about that is, if there's a company that we really like and we want to buy some equity in it, there's a lot of potential sellers. And
Yeah.
so what we typically do is, well, who's been in the longest? Have you been in this thing for 10, 11 years? And so that's typically how we buy, and we focus on those smaller stakes.
Right.
right? So that is a totally different, strategy. We're almost like doing a very different thing every day than those much larger firms.
Hmm.
And what we love to find, so our particular niches, we love to find a company or great companies
Hmm.
trapped in all their funds, taking on that theme we all know. Great companies are staying private longer,
Hmm.
right? So what you find in these 10, 12, 13-year-old venture funds now
Hmm.
are really mature assets,
Yeah.
exit ready, but they haven't
Mhm.
haven't gone public yet. And we're
Yeah.
usually buying them from the A round, B round investor who's done
Mhm.
quite well on paper, but they're not
Right.
liquid yet.
Hmm.
So
Yeah.
that's really a nice dynamic for VCFA. We're sector agnostic,
Hmm.
right? We like to buy a lot of different companies across a lot of different sectors with a lot of different GPs, right? We'll often buy LP interests or do GP led transactions,
Hmm.
such that our funds have, in many cases, 150, 200 portfolio companies in a single fund. And
Hmm.
you may ask, how do you manage that? We don't. There's a lot of we're funding managers, so GPs. We're doing GP leds to say, okay, take those 5, 12 assets, put them in a new fund. We'll fund that fund, and you
Yeah.
manage those for us. Because David and I can't be on 100 boards, right?
Hmm. Yeah.
So we actually have a bit of an indirect strategy. And about 10 or 15% of our portfolio is direct, where we will buy,
Right.
direct equity in a company.
Yeah. So can you share a time when VCFA Group, acquiring a business or investment, a complex secondary deal, and what were the key challenges, and how did you overcome them during the deal negotiation and structuring
Yeah,
of the deal?
Tahir, that is a great question because that's kind of what we specialize in. I think
Hmm.
what we're known for is smaller, complex transactions.
Hmm.
And the reason we're known for that is because, as I said, my friends and a lot of people I know in this industry have 20, 30 billion dollar fund sizes. They can't put that to work, that amount of money to work in 3 or 4 years doing 30, 40, even $60 million
Hmm.
transactions, right?
Hmm.
So because we're small and we have been here from the beginning, we're very experienced, we can handle real complex transactions that happen to be not that big. So we're
Hmm.
really in the sub $100 million, and I'd say our sweet spot is in that 20 to $60 million fund restructuring type of transaction. So I'll give you a good example. In our last fund, our kind of one of my favorite deals we did was we bought the venture group
Hmm.
out of a very large hedge fund that you would know, right?
Yeah.
They're by size probably a top three
Hmm.
hedge fund. However, this hedge fund had some had some specific needs as well. One of them was they don't like people knowing what they're doing.
Hmm.
So one thing about VCFA is we're discreet. You will not see a
Hmm.
press release in the last 44 years from us about a deal we closed and who
Right.
we closed it with.
Hmm.
Okay. So discretion was very important to them.
Hmm.
Number two, they are highly, highly, highly uh, compliant. So
Right.
they really want no risk on the compliance side. So they didn't even want with super thoughtful NDAs and say they didn't want to share any of the information that they had from their underlying companies and their venture fund with
Hmm.
us.
Right.
Well, that's how are you going to sell something when you can't tell
Yeah.
someone what the company's revenue is. The great synergy there was we've been around a long time.
Hmm.
And so when you're looking at the venture world and really what I'd call the end of life venture, the really mature, that's a really small world, right?
Hmm.
And when all you do is stare at it every day like we do, we looked at their portfolio and 70% of the value is in 3 or 4 companies out of 6 or 7 that were left in that $100 million portfolio. Uh, we were on the board of one. We knew 2 others very well. So we said, you know what? You don't even need to provide us the information. We think we've got it.
Hmm.
So from there, what we were then concerned about, like price, would they go for our price? This was about $104 million of fair market value, and quite frankly, our bid was sub 60 million.
Hmm.
And so, a lot of folks would ask us the question about this deal and others. Who would ever sell you, you know, a group of really good private equity, in this case, much very late stage, exit ready, one of them known to be going public assets at that big of a discount within a year of one of them going public and a couple of others like really selling or
Yeah.
liquidating. And who would do that? Well, an 80 plus billion-dollar hedge fund who is managing this $100 million venture group in 9 international side pockets.
Mm.
It's costing them time and money to do all this reporting, and the terms on them, the terms on the side pockets are running up, et cetera. So this really became more of a nuisance thing
Yeah.
than anything else. And so while it was part of their strategy to get rid of this, the priority kept it kind of number 11 on the top 10 list for so long, where finally the internal management committee said, we need this thing gone. And
Mm.
so we just happened to meet them at the right time where they were able to sell us great assets at a price that was really good for us and our investors,
You still
but solved
holding
the
those
problem for
assets, or you exited? You still
we,
have?
you know, that transaction, just to toot the VCFA horn for a minute, that transaction within 2 years had returned more than 3x capital back to us. Yeah.
Wow.
So when we can find those transactions where there's dislocation, that's fantastic. And we're constantly looking for that arbitrage. So what I like to say in most cases, VCFA is looking for the arbitrage of time more than anything else.
Yeah.
So let's just say, I love to use this as an example to here. Let's just say you made a $10 million investment in a venture capital firm 13 years ago,
Mm.
and they've returned $16 million of capital back to you. And the last account statement to you said you still have $2 million worth of fair market value left,
Mm.
but it's going to take us 3 to 5 years to get rid of, to exit that. So 10 in, 16 in your pocket, fair market value of 2. It's going on year 13, 14. It's going to take another 3 or 4 years to go. Your IRR is maybe in the mid-teens right now.
Mm.
Okay.
Yeah.
So you have this $2 million NAV, and you really do not like my $1 million bid. You might even be offended, right? You might say, well, how can you bid $1 million on my $2 million bid?
Mm.
But then I'm going to show you a table that says you passed your max IRR about 3 years ago when it was 17,
Yeah.
and now it's 14. And I can say if the GP's right and they can get you your 2 million or 2 million in a little bit in the next 3 to 5 years, that's probably going to be at an 11 or 12 IRR.
Yeah. Yeah.
Right. And you'll get your 1.8x.
Mm. Yeah.
I think two very intelligent people or a committee and VCFA can come up with the right solution, which is you should take a 1.7x now
Mm-hmm.
and maintain your higher IRR.
Mm-hmm.
And so I call that the arbitrage of time. There could be very good assets left, but that 20% or less than 15% of the overall fund, now that late in the game, that tail cannot wag that dog. In other words, your return multiple and your IRR either can't change or it's probably only going one way and it's down. So that's where reasonable people can transact at what seemingly is a pretty big discount, even though the assets in that fund might be great. And the only reason we'd buy them is we think those are great assets, right? But we're going to need to buy them at a discount because we don't have the 7-8 years of growth ahead of us. We're looking to buy exit ready assets and be out in the next 3 to 5 years. So that's a great profile for our investors. So it's kind of a nice dovetail for people who have been in good venture funds, who've done okay, but are looking at that longer tail and saying, look, I've only got 10, 20% left of this fund. It's now getting long in the tooth. I can actually perform better than the LP that stays in for the whole duration. Many of the people that sell to us, insurance companies, institutions, pension funds, et cetera, have done that calculation and say, actually, it's better for me to sell at a discount now. Why? Because a lot of those folks are paid good salaries and paid a lot of money to manage private equity, and they're judged on 2 things, their return multiple and their IRR.
Yeah.
So they don't want to watch it slide.
Yeah. So, so the complex deals are good deals. So that's why, there's good return in the end.
Yeah. Complexity usually means a little bit more opportunity for the buyer, right?
Exactly. Yeah. So, what are the some of common mistakes sellers make when trying to exit their private equity positions?
So I think the selection, if you're going to sell private equity assets through an intermediary, I
Mhm.
think making the right selection of who that intermediary is everything.
Yeah.
So, there are some large intermediaries in the space, Evercore being, I think, one of the best known.
Mhm.
And then some of the other large banks have large practices, and they are all really talented. I mean, look, there's some of the best investment bankers out there are in the secondary space. However, if you're selling a smaller portfolio, um, and it's a specialized portfolio of assets. So if you're a GP or an LP looking to sell something specialized, I would do some real homework before I just went with one of the big names
Mhm.
in an intermediary, because the smaller intermediaries, in many cases, they're people who have left the larger um, investment bank intermediaries and started their own firms. They have relationships that are specific. I'll give you a biotech.
Mhm.
Right? If you're trying to sell biotech assets or healthcare assets, there are smaller intermediaries that are going to probably get you better pricing because they have a better network in people who buy those sorts of assets. Venture growth.
Yeah.
There's some smaller intermediaries in growth who I would say more often than not,
Yeah.
about we've been around forever, so we enjoy, as they say, over the transom deal flow, right? We get hit with a lot of deals because we've been around for over 4 decades. But about half of our transactions are closed through intermediaries. The confusing part of that might be that's competitive.
Mhm.
More than half of those intermediate transactions that we do are people who had a seller. They looked at the deal. Wow, this is complex. Wow, this is venture growth. Wow, it's small. It's no one's going to want to do this except maybe these three. And I'd lead with VCFA because one uh, one thing about our reputation, if we deliver an LOI, we're probably 4 9 certain that we'll get the deal across the finish line.
Mhm.
There's about a 50, sometimes 60% fallout
Yeah.
of deals that don't happen
Mhm.
based on complexity and stuff. So choosing that intermediary who can help really steward the deal along is one thing, but finding the right intermediary who can put you in contact with the right buyer in the first place
Mhm.
is everything.
Mhm.
And so I think some people just go with the biggest name they
Mhm.
know, and that's safe, and no
Yeah.
one's gonna argue with it.
Yeah.
Um,
And also the
may mean you're leaving money on the
bigger,
table.
yeah, also the bigger names that take longer time to close the deal as well. I assume that you can close the deal much quicker than the bigger names. Yeah.
Well, look, there's a bit of a perverse incentive in taking
Mhm.
a not so huge deal to the
Yeah.
largest
Mhm.
intermediaries.
Mhm.
They're they're paid on a percentage of the deal.
Yeah.
So your $28 million deal or even your $88 million deal is not going to get the attention the $500 million transaction is,
Mhm.
right?
Mhm.
So think of size, think of if these are specialized assets or if they're in a specific sector, start doing some homework on where maybe the better intermediary choice is.
Mhm.
Um,
Mhm.
and then other than that, I think some people make the mistake of overlooking the dynamic that we were just talking about. I
Mhm.
need, if I can't sell these for 80 cents on the dollar, I'm not selling. Well,
Mhm.
actually, sometimes taking the 70 cents on the dollar is going to preserve a better MOIC,
Mhm.
a better IRR, and really not move your MOIC more than like 10 basis points. So what are
Mhm.
we talking about here? So sometimes being too price conscious and really setting a mark
Mhm.
when you're not modeling the overall return
Mhm.
and keeping in mind where that fresh powder you're going to be getting from the sale, what IRR that could be getting, right? So you're really, no one's just selling and taking the money and shelving it and holding it in cash. Usually there's a purpose for the liquidity.
Mhm.
And if you're taking in mind that the liquidity you're going to get from this sale is going to be in a much higher IRR, newer, growth investment, then
Mhm.
it makes sense to kind of arb a little bit and say, look, I'll take a discount on this asset because the IRR is going this way
Yeah.
at year
Yeah.
13 and later, and I'll
Mhm.
put it in new investment where I know my IRR is going to go almost to a not material high, which is the benefit you get of secondary investing earlier in the game because we're buying at discounts.
Okay. So where do you see secondary private equity market is heading in next 10 to 15 years?
So I think it's going to probably 3x or 4x in size in the next decade, at least, maybe 5x. And and I think there will just be much more specialization as things grow. So I think you'll have the biggest firms get doubly big and huge, and they'll gobble up a lot of that, massive deals. This is when CalPERS or Harvard managers selling a couple billion at a time of private equity. So that will always be there. That's a mainstay of the market. And that's where 80+% of the dry powder will always be in transactions. The 20% will really start to be, I think, more folks like VCFA, experienced players looking at real, niche strategies. And you're already seeing them. You see folks who are just doing structured transactions. You see folks who are just doing, healthcare. Folks who are just doing, venture growth only, like us. So I think you'll see specialization. I think you're probably going to see a little bit more I think there's demand for, and VCFA is going to launch a small fund in this strategy, is PE real estate secondaries. So there's probably no more bifurcation of big to small than there is in that market. So there's a lot of PE real estate firms, Blackstone, Lupert Adler, Kane Anderson, many large firms have a real estate private equity arm they're huge. And there is Landmark, Goldman Sachs, Stepstone. They are larger, multi-billion-dollar fund sizes, secondary PE real estate firms.
Yeah.
If you have a small $2 million LP interest that you want to sell in a older Blackstone fund or Bain real estate fund, good luck. I mean, there's almost nowhere to go. Yeah. And so that's one place VCFA is looking. I think you'll see others, just because what we're seeing now is demand for liquidity in these 12, 13 plus 14-year-old PE real estate funds. Yeah. Some of them have fared well. Some of them have a lot of headwinds right now. And so I think we're going to see a wave of sellers coming to market looking for liquidity. A good portion of those, if you look at the construct of those PE real estate cap tables, the investor base, a lot of them are small single family offices who put $3 to $5 million out there, remaining NAV of 1 or 2 million. It's just not a deal that a multi-billion-dollar PE real estate secondary firm can look at on a one-off basis. So there's one growth market that I see, right in front of us. Yeah. The other one that we're looking at, and just for full disclosure, we've done 0 investments to date in our main funds in digital assets, blockchain. Crypto is not really for us. We've been watching that sector very closely since 2017. And while we don't think it fits in our main, venture growth strategy, we are taking a very close look at that opportunity that exists right now, which I think there's an interesting arbitrage. The largest and say leading digital asset infrastructure companies are still mostly private. Coinbase went public. Right? Coinbase went public. What is it, $75 billion market cap? They're the 5th largest exchange. Yeah. The other 4 are private. Kraken, is top 10. They're still private. Yeah. These are large, several $100 million of free cash flow companies. Yeah. They're healthy. They've lived through a compliance environment in the last SEC that was like handing out Wells letters, like putting everyone knows. So these are now mature, large, very profitable digital asset infrastructure companies that are really attractive businesses now, and they're all private. So what does it mean when they're private? Well, private companies lag in their valuation reports. Yeah. Right? So if they were public, look, since the election, the market's been on a tear. A lot of people think, look, the whole market just follows Bitcoin and that
Mm,
price. To an extent, Bitcoin is a very big ballast to that market, and it will do. But now there's a real companies doing hundreds of and billions of revenue that are private, that are cash flowing, really nice
yeah.
assets.
Mm,
The arbitrage there is people are still looking at either 630 or 930 reports
mm,
on the values.
yeah.
Where do you think 331.25 values will be if you look at where the market's gone
Mm,
post election? So that arbitrage right now is you can give a really good looking price to the last fair market value that
yeah.
investors are looking at right now and still be saying, wow, I'm buying this at a great value,
Mm,
right?
yeah.
So I think that is another, those are two areas that we at VCFA are looking at very closely. But I
Mm,
think, I'm sure we're not alone.
mm,
There's some really nice dynamics ahead for the secondary
mm,
market for niche
mm.
players, staying clear of the
So
massive
at
buy.
VCFA, you only look at deals in US, or you do also cross-border transactions as well?
We will look outside the U.S., but it's really just it's just it's in our investment and the money we put out is indicative of the size of markets. If you look at venture
Mm,
growth equity in general, and really what we're looking for is you know great growth, high quality companies that are exit ready. It just so happens that most of those are based in North America. We've done Western European deals. We've looked at deals in China, India, this and that. It just so happens that we don't like things like currency risk. We don't like some things. So when you look at the just the numbers and how many great deals are sitting here right under our nose, being based in Manhattan. Um, it really tends to be just that we think the best deals
yeah.
are here. So while geography is a bit of is a bit of a factor for us,
Mm,
it's not the factor. It's certainly not the top five. It's all the other. Is this a great company? Is it growing? Does it have a good management team? Is it exit ready? Are we within 3 years of an exit? All of those things tend to lead us mostly, or
that's when you have
88%
enough fish.
back to the United States of America. So.
You have enough fish. You don't need to go deeper. Yeah.
Yeah, it's
Yeah.
just the way
It
the
makes
way the
sense.
number.
Yeah, it makes sense, and less risky, and so you know the market well. So
Yeah,
yeah.
yeah.
So Andrew, this has been really insightful conversation. So where can our listeners connect with you and learn more about VCFA, or someone wants to connect with you for
So yeah, if
meetings and
if
so?
anyone, we myself, David, Tom, our whole team is in Midtown Manhattan, on Park and 56th,
Mm,
and you can look us up at www.vcfa.com and get a better understanding that our site's pretty comprehensive about a little education on secondaries and how we play the secondary market. And you can find me on LinkedIn. I'm easy to find on LinkedIn, Andrew Reilly, VCFA. And we love talking about secondaries, as you can tell. So if you just want to talk about secondaries, or if you have a question about a transaction, me or a member of my team is always willing to listen.
great. Thank you so much, Andrew. Thanks
Thank
for
you, dears. It was
yeah.
great.